Welcome. In this video, is Xcn coin ready to go up? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand. Careful technical analysis of the chart shows that the price has been moving downwards for a long time and has formed a falling trend line in line with the trend. This trend line is a strong indication that the market has not been sufficiently supported by buyers for some time, while selling pressure plays a more active role in certain periods. Downtrends are often characterized by successive lower highs and lower lows. This structure indicates that the market is in a downward trend and the overall direction is negative. This falling trend line is formed by connecting at least two or more peaks on the chart, and it acts as a line of resistance every time the price attempts to move up. Every time the price approaches this level, sellers step in and put pressure on the market. The top of this trend line therefore acts as a structural barrier in technical terms and psychologically represents a threshold that many traders need to cross before making a buying decision. However, such downtrend structures cannot be expected to last indefinitely. Over time, when the price repeatedly approaches this line and is rebuffed at every attempt, sellers gradually start to lose their strength. As buyers continue to support the price near this line, the market's equilibrium point moves up. As a result, the pressure on the falling trend line increases, and if it is broken to the upside, the current negative trend will end, and a new uptrend may begin. An upward break of the trend line is not only a technical breakout, but also a serious transformation in investor psychology. Because this line has functioned as a barrier for a long period of time, it also changes traders' perception after it is broken. The exit from the bear market is now accepted by a wider audience, and this can bring a fresh wave of buying to the market. Technically, breaking above this zone confirms the trend reversal. Also, when trend lines are broken, a behavior called retest is often observed in technical analysis. The price returns to this broken line and tests whether it will now work as support and not resistance. If this test is successful, that is, if the price manages to hold on to this line, a new upward momentum may build. This momentum could lead to higher highs and lows in the market, creating the building blocks for a new bull trend. However, the critical factor for traders is that the price not only breaks the falling trend line, but also confirms it. Post-breakout candle closes, especially when analyzed on daily or weekly time frames, provide a clear indication of whether the trend has actually changed. In addition, the bursts of volume immediately following the breakout confirm that the market has accepted the change and has established a new direction. As a result, an upside break of the falling trend line, which is clearly visible in the current technical structure, could be a major turning point for the market. This line is not only a technical barrier, but also a psychological barrier in the minds of traders. Breaching this barrier could cause the market to gain momentum, boost confidence, and trigger strong upside price action. Therefore, breaking above the downtrend can be an important catalyst for technical analysis that can open the door to a bullish breakout. But we can't decide on analysis based on trends alone. Let's look at other metrics. Stay tuned. The Elliott wave theory, often used in technical analysis, is a powerful theoretical approach developed to make price movements in the market more predictable and to enable investors to predict possible future movements. According to this theory, price movements in financial markets follow certain wave patterns, and these patterns are cyclical in nature. In this context, a careful analysis of the current technical structure shows that the price has already completed the first two structural waves. That is, the first and second waves have clearly formed. This suggests that a critical stage has been reached in terms of market volatility, and that the longest and strongest move, usually the third wave, is approaching. The Elliott theory has a bullish sequence of 5 main waves. The first wave usually represents the first spark in market psychology. This first spike is usually noticed by a certain segment of the market, even if it doesn't generate much enthusiasm. The second wave is the correction that follows this initial rise. At this point, the majority of traders usually pull out or remain cautious, thinking that the price will fall again. However, technically this wave is the preparatory stage for a much bigger move, the third wave. A similar structure is evident in the current technical outlook. The first wave has completed its upside and the second wave has finished its correction. Price may now be positioning for the third wave, which will build on these two foundations. The third wave is usually the most aggressive and most noticeable part of the Elliott structure. This is because at this stage, investors now recognize the bullishness, confidence grows, market participants proliferate, and trading volumes rise significantly. The third wave is therefore one of the most influential price movements, not only technically, but also psychologically and sociologically. This wave is usually 1/618 to 2/272 times longer than the first wave. These ratios are calculated by measuring Fibonacci expansion levels. The current technical structure suggests that the price is likely to head towards these expansion targets. At this point, the target levels of the third wave movement are determined by Fibonacci-based calculations. The first wave height is measured, and these length ratios are applied to the point where the second wave ends. While the most common third wave target is the Fibonacci 1/618 level, in strong bullish scenarios, this level can be seen as 2/272 or even further. This means that the price could break out to the upside quite aggressively in the coming periods. Especially with the start of this move, traders' interest in price movements increases. Technical indicators move into positive territory, and the trend turns completely bullish. The third wave is not only a technical bounce, but also a process of awareness on the part of market participants. The price volatility of the first and second waves can often be ignored by small traders, but once the third wave begins, everyone wants in. This wave is often supported by news flow, meaning that the price gains momentum not only technically, but also in terms of fundamental analysis dynamics. Therefore, at this stage, trading volumes increase significantly, and prices can make sudden jumps. Another factor solidifying the bullishness of the third wave is the support levels formed during the previous second wave. These levels can be tested in the event of a pullback, allowing higher lows to be created instead of new lows. Thus, the market begins to structurally form rising lows and rising highs. This structure is one of the most important indicators of trend reversal in technical analysis. In this context, the key elements that traders should pay attention to are the following: the length of the first wave, the depth of the second wave, the level at which the third wave begins, the Fibonacci target zones, and whether the technical indicators are synchronized. If all these elements are working in harmony, the probability of the third wave reaching its target levels is quite strong. Frequently used in technical analysis and highly valued by traders, the RSI, or Relative Strength Index, provides critical information to understand the strength and momentum direction of price movements, as well as identifying overbought and oversold areas in the market. The RSI can not only be evaluated with certain threshold values, but it can also contain trend structures, breakouts, and patterns within its own internal structure. In this sense, a falling trend structure above the RSI indicator actually indicates that market momentum is gradually weakening and selling pressure is technically dominating the price. In the structure currently being analyzed, the RSI value has formed a series of lower peaks over time, and the combination of these peaks forms a clear downward trend line. This line is an indication that not only the level of the indicator is trending down, but also the momentum of price movements. This falling trend line on the RSI acts as a hidden resistance. Even if the price tries to go up, if the RSI cannot break through this line, the momentum has not yet gained enough strength. We can wait for the RSI trend to break because that's when the price will attack. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.